All right, guys, welcome back to the channel. And in today's video, I wanted to do a quick portfolio update and also to showcase what I'm doing in this market volatility. So, first thing is, I logged into LinkedIn today and I saw Ben, the CEO of Composer, um, posted this. He said, "People keep asking me how Composer is doing with this market volatility. We've seen virtually no churn and AUM hardly dipped. Now we're back up to our highest level yet. It pays to play the long game." And that last line, "it pays to play the long game," made me think of the famous Fidelity study where Fidelity and its millions and millions of accounts did a study on its best performing accounts. And lo and behold, those were dead people and people who forgot they had an account with Fidelity. And so, it also makes me think of the famous um, Jack Bogle line in the midst of market panics and sell offs and recessions, depressions, which is don't do something, just stand there. So when you turn on a lot of financial media, CNBC, Bloomberg, online, influencers, and such, many people are going to tell you, like, oh, this is, what I'm moving from this to this, I'm jumping from there to there. And that's not something that I generally do. A lot of times in these situations, I sit on my hands, so to speak, for the most part. But then when I do take actions, I try to take actions that take advantage of the market's bipolar sensibility. To use the Benjamin Graham term, Mr. Market. There's another famous line: the market is not there to guide you, it's there to serve you. And so, to that point, in 2020, I was looking at what's the most undervalued assets, what are the cheapest assets on the planet. And it's something I carried forward. I always try to, every few days, log in, run my screens, and always am on the hunt for what is cheap. It doesn't always mean that I'm going to pull the trigger on those things, be it because I don't have the idle capital or because I think perhaps it's a value trap. But I always like, through my value screens, to really look across the investing landscape and see what is cheap, and then to do some more due diligence as to why it's cheap. Um, so let's so let's get started with just kind of a portfolio update. The portfolio peaked at about 1.2 million, and now it's in the probably mid eights. So let's go through it. Let's start with the main account here, TD Ameritrade. And so you can see 472 is the value. You can see right now, let's see where the market is. It is 206 on Thursday. So you can see S&P down 1.53%, Dow down 1.51%, NASDAQ down 1.66%. And so you can see this particular account, this is so the long view here. And what's interesting about this particular sell-off, it's been a lot more gradual. It's been like a lot of others in previous history, whereas the COVID sell-off was quite dramatic. So you can see in this particular account, this was February 18th, 2020, 362 is the account, and then 203 on March 20. So you can just see with the line here, it's a pretty brutal, swift drop. Whereas here, you can see that this account peaked in like November, December, 665, November 9th, and and then 651. So yeah, it looks like that early November. But then you can see it's just kind of been like a gradual up until maybe April, maybe end of April. The last few weeks it's been a little bit more accelerated here. Actually from here, let's say from April 4th to now. So the last month it's been a little bit like this, but not as dramatic on here. And then let's look at like the 1 year, and you can kind of see here. So you can see 1 year, this is going back to May. Today is May 12th. Yep, May 12th, 569 down to 472. So almost 100,000 exactly. But again, here you're able to see more of that drama that quicker sell off. And then we can look at year to date here. And, so you can see it opened here January 3rd at 644. So you can see it year to date, it's been pretty brutal, right? I mean, you're at 644, 444 being even 200,000. So we're only, about 30,000 away from that. So if the sell-off continues, it'll hit that 200,000, down from January. So yeah, that just kind of gives you a sense as to what's going on in this particular account. And then we can go to, this is Alpaca. This is where I have a lot of my quantitative strategies running with Composer. And so you can see this is 102 today, down 1.44%. And you can see the year, it kind of peaked like almost just at the end of the year at 154. And then it's gone down, 50 some thousand there. And I actually allocated this capital like right before, like November. I think it was November into December, right when things went kind of down. But that's part of investing. I mean, it's like if someone, I don't know, started investing in 1973, 74 when Warren and Charlie said it was the worst time to invest, or if you invested right before the 87 crash, or right before the .com, or right before 2008, takes time to come back, and it's just part of it. But I always kind of say to myself, I wish Composer had been around 2 years ago, because I would have taken advantage of the run up on a lot of the strategies I built out. But that's life, and that's where it is now. So not a big deal. And then the other account here is 241. This is Interactive. So let's just tally these three up and kind of get a sense. So 241, 688, and then let's go back here. 102, 384, and 472, 688. So 816, 740, and then I have another 30,000 or so in some smaller accounts. So right now I'm hovering about 846. The peak on this account was about 1.2. So about 300,000 to 400,000 overall from the very, very peak. And but the thing I would say is one of the things that I'm doing right now, and it's just kind of set up on autopilot, is reinvesting dividends. So a lot of dividends are coming off in my TD account here, and I'll just give you sort of a sense of what I mean by that. And this is sort of plays to Bogle's point of don't do something, just stand there. So this is just today. Let's just go back like 7 days maybe. And then let's click on dividends. And then we're going to go view. Okay, so dividends. Okay, so you see PNC, $14 dividend, Race, $24 dividend. And then huge dividend right here from Blackstone. This will be a good example to prove my point. So this bought, I want to say almost 1.99, almost 2 shares of Blackstone, because Blackstone was trading 120, 130, 140, and it sold off on this day 5.9. It was trading at about $99, $98. So it sold off $20 or $30 per share. So when we get through this, whether that's tomorrow, next month, next year, 3 years, 5 years, and we come out of this, I'll have picked up cheaper shares. So by reinvesting your dividends in these big sell-offs, you're really taking advantage of that. Here's another, dividend: Albertsons, BTI, British Tobacco, BK, Bank United, or Bank of New York Mellon, Whitestone, Synchrony Financial. These just came off like a few hours ago, actually. So that's just something, it might seem like trite or inconsequential, like, what's $200 when you're down 200,000, but that's how you really compound. And it's kind of makes me think of that famous Warren Buffett story where he was in New York and he walked into an elevator, and there's two investment bankers in the elevator, like shocked, like, oh my God, it's Warren Buffett in the elevator with us. And there was a penny on the floor, and he picked it up and he said, the beginning of the next billion. And so little things like this, like the reinvestment of dividends and doing that. Let's say there's a big recession for 2 years and I just sit on my hands. And let's say my accounts go from 800,000 to 500,000, but I'm constantly reinvesting those dividends. When we come out of this, I'm going to accelerate a lot faster than people who went to cash or so on and so forth. And it had me thinking also, like, this really doesn't affect someone like myself because I'm 42 years old. And so, okay, on paper, it goes from 1.2 to 8 or 1.2 to 7 or 1.2 to 9, right? Who it really affects are people who retired last year and they're doing the 4% rule. And let's say they have 500,000 or 600,000 in IRA. So now they sell 4% of their assets for the income to live. And then this coming, let's say January, if the market sells off worse, and let's say it's a 2-year situation, they're going to sell off again in January 4% for their living. So, that's where it can get dicey is, retiring with the 4% rule in a prolonged bear market. So for someone like myself who's very opportunistic, I think this is something that will do me good, so to speak, because of, I'll still be collecting some option premium, which I'll be buying stocks and so on and so forth. So in the long term, I think for me, this is going to be a benefit, but for a retiree, either last year or this coming year, that's who it can really, really affect negatively. But let's finish out the video. I want to finish out here, and it's sort of what I said of being a hunter. I consider myself not just an investor, but a hunter. And so I'm always hunting for things that are worth $1 that are trading at 50 cents. So I'm always running my value screens and looking at what is cheap in this market on, price to earnings, price to book, price to sales, price to free cash flow, different metrics, PEG ratios. So let's just pull up here. This is Guru Focus. They're a big value site that I belong to. And this is let's see what this one, this is the undervalued predictable companies, discounted free cash flow, and discounted earnings. I always like to see what's showing up. And I mentioned this, I think, earlier. AutoNation. I mentioned this to my friend Logan Kane, writes for Seeking Alpha. I think he might be maybe considering doing an article on AutoNation. I was telling him maybe he should, because AutoNation is showing up in so many different value screens. And that's something I also look for. If something is showing up on a value screen in Zacks, and it's showing up on a value screen in Guru Focus, and it's showing up on a different value screen, it's like, wow, these companies that are connected, the screens are different parameters, and yet it's still showing up. So you're seeing AutoNation there show up on this one. Let's see what else is here. That, US Bancorp, USB, I think I own that also. Bank of New York Mellon, I just got a dividend from them. So there you go. That proves my point. Bank of New York Mellon is something that I already owned. It threw off a dividend, so which I repurchased new shares of what you could look at as an undervalued asset. So let's just go up here. This is the undervalued predictable. Let's just pull up Buffett Munger screener, and you can kind of see. So a lot of home builders, DR Horton, LGI Homes, a lot of automotive, Lithium Motors, AutoNation. There it is again. You see on the Buffett Munger and the discounted, Lazy Boy, DaVita, okay, Old Dominion Freight, and let's look at the Peter Lynch. I also, I like to look at all these different ones. Peter Lynch screen is also good to look at. Morgan Stanley. So, a lot of financial services companies are showing up in some of these backs. First Bancorp, Farmers Merchants Bancorp, Morgan Stanley, Raymond James. So a lot of financial service companies are looking cheap. Sun Life Financial, Bank of America, Best Buy, LabCorp, Tyson Foods. Tyson Foods is another one that I own, and that I'd like to maybe take some more position in, with some of the option premium. And then what I like to do also, I like to pull up fast graphs, and I mentioned Tyson. So let's let's just do that one, just a quick little view. And this gives like a snapshot valuation, like a quick, okay, let's take a look at it. So anytime the black line is under the blue and the orange line here, what's the Graham Dodd 15, it's generally considered undervalued. So you can see that it wasn't undervalued here, and then all of a sudden here in 2020, it's been consistently undervalued. So that makes sense that it's showing up on a value screen. Earnings per share rolled over the 6.5 that Chuck likes, at the owner of Fast Graphs. And then let's just pull up a couple other financial services, banks, things like that. So you got Bank United also trading right here. You're seeing the gap between the blue and the orange line right here. Let's pull up another. I mentioned Bank of New York Mellon, which is showing up on another value screen. There it is. Boom. Look at that. So you can see also, it kind of came back, and then now it's trading. Look at its earnings per share yield, 10.05. Nice dividend payer over 3. I mean, it's trading in single digit price to earnings. So let's just take another. Let's take like Goldman Sachs. I bought some of that a few months ago. Also look at that gap here. I mean, and this is something for Fast Graphs. It'd be interesting for them. I don't know how they could do it. If they could actually have a list on the most undervalued assets on the planet. Basically, the biggest gap between the blue line here and the black line, and then the orange line and the black line. If they could somehow rank the entire stock market on that would be phenomenal. I don't know if they could do that, but Chuck, if you're watching this, get your programmers and your techies, your coders, to maybe see if you could do that as a screen, ranking them on the biggest, what we would use the term margin of safety between the blue and the orange, is the best way to say it. I mean, look at Goldman Sachs's earnings per share yield here, 17.22. It's trading at under 6 times earning. My God, it's not a 3%, but it's 2.65. Nice dividend. So, that's why when you turn on the financial mean, you see this big sell off. There's things that are modestly valued that you can take advantage of if you take the time to do the fundamental research. So that just kind of gives you guys a sense of where I am with the overall portfolio. And what I do in situations like this is, again, I am a hunter. So I'm hunting for cheap assets. So any questions, concerns, feel free to write in. Remember, guys, I'm not a financial advisor. You have to do your own reading, research, meet with a financial advisor. This is for entertainment only. That's the, kind of the disclaimer at the bottom here, which all financial influencers need to mention. But I like that it's more, for what I do, is kind of financial entertainment and financial voyeurism. You're able to see what I'm doing, and I showcase it with transparency in literally my brokerage accounts and my rationale. So you can see mistakes I make, or decisions that I make that bear fruit or bear dividends. So with that being said, take care, guys. Ciao.